Trend Signal for our review of the data and events the week beginning the 6th of February. Last week, markets were not particularly impressed with the Trump angst, twittering, criticizing the judiciary, all sorts of stuff going on really, all leading to a bit of a mess. The FTSE was unchanged last week, whereas the Dow and the S&P were marginally down, but only slightly. The bigger movers were really on the back of the weaker dollar, causing the DAX to come off 160 odd points, which is what 1.5%, and the Nikkei also retreating 550 points, so close to 3% move there, as the Japanese yen rallied another 2 yen to the dollar, which is what, over 2%. So it's all currency moves really. Equities sort of remaining in the headlights of the Trump flux, as it were. Obviously, US dollar-based commodities reacting positively to the fall in the US dollar. Gold rallying sharply, really, I guess, as a geopolitical risk gauge, as much as in reaction to the dollar fall. But I think markets are reacting by not knowing what to do in a way. The dollar is bearing the brunt at this stage with the output from the White House, and I think it's likely that we might see a bit of backing and filling this week, but certainly it's a crowded trade where a lot of traders are long dollar and surprised by the move so far this year. Typically, the dollar tends to do quite well in January and February, so seasonally it should be rallying, but that's certainly not happening. As I say, a lot of people are already long, which may be part of the reason. Last week's data was mixed, really. Chinese bank holidays throughout most of last week, returning on Friday. Central bankers still casting their shadow over the market, as they always have been over the last few years. But Mark Carney from the Bank of England surprised the markets with an increase in the growth rate for the UK this year, lifting it markedly, actually, from 1.4% to 2%. But he did say that growth is expected to slow in 18 and 19 to 1.6 and 1.7% respectively. So interesting reaction to sterling on the back of that, though. Sterling fell over a cent versus the dollar on the move on Thursday, mainly because I think Mark Carney reiterated the fact that the Bank of England was prepared to tolerate an overshoot of the inflation rate. So in effect, interest rates would not be raised in response to a modest overshoot of the 2% target, hence the sell-off in sterling. Interesting that a number of reports now, some notable institutions calling for a rally in sterling post the triggering of Article 50. I think a bit like the dollar trade in general, it's a very crowded trade, short sterling, and maybe we might be running out of sellers there. And obviously, that's the main event. When it's known, once it's triggered, there may not be much to aim at after that. Of course, negotiations, but that's over 2 years. That's not something that traders could focus on a specific time and date, though. So the dollar outlook seems to change from day to day. Comments from this chap, Peter Navarro, who's head of Donald Trump's National Trade Council, saying that the implicit Deutschmark, i.e. the euro, was grossly undervalued, certainly for Germany, effectively giving Germany an unfair advantage, albeit, I guess you could say, not one of their own direct own making, I should say. It's possible that Germany actually could be included in a list of countries accused of currency manipulation by the US, which sounds extraordinary, doesn't it? But since then, Wolfgang Schäuble, the German finance minister, has actually come out and said he blamed the European Central Bank for an exchange rate that is too low for Germany. Yeah, well, that's certainly the case, but that is the issue with the euro, isn't it? An exchange rate and an interest rate that is out of kilter for quite a few members of the Eurozone. That's one of its main problems, I guess. Data and events this week, let's have a quick look. Very slow week for data, really. If we look at the main ones, the ones with expected high impact, there's very few out this week. More central bank monthly policy meetings starting on Tuesday evening with the Reserve Bank of Australia, no change expected there, followed by the day later with the Reserve Bank of New Zealand, no change there as well. Really, the data's pretty thin on the ground this week, to be honest. We have to wait until Thursday, really, before we get the weekly regular unemployment claims. And then we have the first real sterling news, manufacturing production, out at 9:30 on Friday. Pullback from the previous month's data, but all the PMIs still remain quite positive. The service sector PMI last week, whilst it did fall, it's still healthily above 50, indicating an expansion in the sector. So not too bad news, really. We finished the week with the first reading of the University of Michigan Consumer Sentiment. Really, any gauge of the U.S. Consumer that remains positive, and despite the fact that we're looking for a bit of a pullback, the previous number was revised up anyway. 97.9 is a strong reading, and as a good leading indicator, it does bode well for the future, assuming President Donald Trump doesn't mess it up too much. Time will tell, I guess. That's it. So quite a quiet week. Thanks very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.